Good morning and good afternoon. This is David Balin and Stephen Whiting here in New York and Bedford, New York. And we're here to talk a little bit about a world of difference. What's different between April of 2025 and April of 2026 on The Point. But before we begin today, I just wanted to acknowledge the fact that there is a new mission to the moon taking place right now on Artemis 2. And you may not know that, but Reed Weissman is the commander. Victor Glover is the first Black American who is going to visit the moon. Christina Koch, who is the first woman who will be visiting the moon and is also the longest single spaceflight holder of women with 328 days in space prior to taking the Artemis flight. And in a shocking change of policy, we have also launched Jeremy Hansen to the moon, who will be the first Canadian. So in spite of the fact that you think America and Canada are having issues, we have launched the first Canadian to the moon. And with that as backdrop, and I hope that you'll enjoy the fact that we do need a bit of levity, even as we send people around the Earth and to the moon. They'll probably be very happy that they went on this trip because we'll be talking about the difference right now between what's taking place here on Earth. You may have watched President Trump speaking on a national address. He said that it will be 2 to 3 weeks before the war will end, and that he intends to take some significant action against Iran as a result of that. We saw oil spiking price higher last night. We've also seen a bunch of energy traders looking at global oil trade as rebalancing. And Stephen's going to talk a lot about the data associated with this, because there's a difference between what the energy markets tell us, what the stock market tells us, and what actually is the difference between this current shock and the one that we had last year. Taking a look at futures prices, we expect to see, the impact of energy and energy prices being higher as significant on GDP. We'll talk a little bit about that. But there are lots of differences in the backdrop now in terms of where employment was in April of 2025 and where employment and employment growth are now. The S&P fell 20% last April. It has fallen about 9% from its peak this April. We'll be talking about the differences right now in markets. And then we'll talk about our analysis, basically, of the difference between those two shocks in terms of their potential outcomes. And while the energy crisis could become a more significant impact to the extent that there's more damage to Middle Eastern infrastructure or a much longer wait before the Straits of Hormuz opens. So with that, Stephen, and with the hope that you will stay grounded with me here on Earth during the remainder of this conversation, let's take a look at the next slide.
So why don't we just talk a little bit about the state of play on this right now? Markets are in the fog of war. There's very easy to be misled by the way things are going from various words. Markets took a lot of comfort from some by some leadership in Iran that there was in fact going to be a path to an end of the conflict. This is after President Trump made numerous comments suggesting there were negotiations that this could all end very soon. What you can see from these charts, though, is that shipping of oil in the Persian Gulf is extremely limited. In fact, shipping is down for every product and it's having a terrible on the people of the region where somebody's trapped in this conflict. But there probably is some more oil getting through than some of these statistics.
Great. Let's take a look at the next slide. So what we're seeing, though, is that Brent prices in terms of futures indicates, right, that there is, a significant decline in price that's projected, right, for future purchases of oil. That makes sense. But the poly market, right, tells us, right, that the probability of a ground invasion is above 60% by April 30th. It also shows that there's a probability of ceasefire by June 30th. In both cases, one of them will be absolutely wrong. Over the course of the next couple of weeks, we do expect that there'll be a resolution in terms of the U.S. participation, in terms of actual conflict in the region. And at that point, unless there's some major change, the future curve for oil will actually indicate what will be taking place as airlines and other major buyers of oil will actually have to lock in prices for the coming 12 months. So let's take a look at one more slide ahead, please. In terms of what is going to take place in terms of inflation expectations. And here, Stephen, we've seen some pretty significant differences, very different between last year and this year in terms of the impact of tariffs on inflation versus the impact of oil and oil price hikes on inflation.
Yeah, I'd like to go to the next page, nail this issue a little bit. You know, we had two cases of significant supply curtailment or a higher cost of output, higher prices, no improvement in income that reduces growth. You have tariffs last year. And when we contrast how markets behave, it's been very much one of overestimated total cost and the impact. You could take a look at that line that said tariffs over the last 12 months have increased by $223 billion. If you took President's comments about Liberation Day for granted and just say, well, those are our tariffs and that's as simple as it could be, that increase would have been $700 billion. Markets crashed, price perception, 20% drop. Here, if we were to just take futures for the United States, across all of our energy costs, I'm estimating a $170 billion increase. That's even less than the tax. Part of the problem is this better be the correct path. In other words, those oil futures, the gas futures prices start to drop off rather quick. President Trump's comments just last night, it's been 2 to 3 weeks of hitting Iran extortion creates greater risk. This lasts long. So when you think of a 20% reaction last year, that drop in the S&P, of course, not everything else is, the U.S. is less impacted than the world, but it very much is not overreaction at the last year.
Okay, we'll move to the next slide. So what we're talking about now is a difference also in what's taking place in terms of investment. And the difference really is that business AI investment, as we've talked about many times, continues to accelerate and will accelerate into 2027. But disposable income, right, of the average, U.S. consumer is actually now slowing to near zero. And this is a difference between now and last year. And we'll see that also reflected, Stephen, in labor statistics, where we see, the actual labor demand is materially different now than it was at that time. Let's go to the next slide where we look at that. What does that mean in terms of our ability to, handle this from an economic point of view?
So it's important to note that we're in the economy last April with about around 1 million jobs created over 12 months versus around 100,000 this year. Is the economy should be less shock proof. Well, it's definitely in an environment now where from personal income side, from the consumption side, it's actually going to be harder for the economy to bear this drag. Now, you can see on this page that the tariff shock was overestimated in markets, again, by 70%. When you take a look at what happens to energy costs, we wanted to put that futures curve for gasoline. It shows it rises right now, then it comes away, then it comes down, right? That's different. But when you go back to the prior page, this point about employment is that we have a situation where AI spending is picking up. It's actually accelerating right now and it's getting very close. So that one piece of the economy is even more important right now. While we're probably going to see the April, May statistics for real personal income are going to be close to zero. Now, again, this shock, energy shocks generally don't have to create a life of their own and catalyze all sorts of things for an economy unless the economy is at an absolute peak. Its relationship to the strongest growth driver, AI spending, is nil. But we want to bear in mind here that, again, this time around, markets are assuming that this drop in the oil price is going to be quick to come. If that's the case, I think we can, in fact, pivot back to growth, but it better happen, right? That's really critical at a time when we're less shock-proof.
That's right. And I think that's the point. The vulnerabilities here are higher and the outcomes skew to the negative to the extent that the actual energy crisis, becomes realized based on what happens in terms of the Iran war. Let's go ahead for the next slide. So what we're talking about now is that just as markets exaggerated the scope of the tariff shock at that time in 2025, it is possible, and I think Stephen's making this point clearly, that this could turn out to be an underestimation depending on what happens over the course of the next several weeks. Now, we want to also point out that if the war resolves, as markets would expect at the moment, then we could see the S&P rise through to the end of the year and actually have a positive gain of almost 10%. But again, the outcome variability, I think, is much more significant at this point in time. Let's move ahead one more slide.
Let's stay on those slides, please, though, and just make
Okay,
sure that it's
thanks.
clear to everybody. So if you take a look at implied volatility in the equity market, different world in oil where you can also have options. But if you take a look at what happened last year, the increase in implied volatility in terms of this history, third highest on record, only eclipsed by the collapse of the equity bubble in the 90s, the 2008 global recession, global financial crisis, and of course the pandemic, right? In terms of that history. This time around, we're sub 30. If you take a look at what happened to share prices, they dropped nearly 20%, almost 20% in April of 2025. Now they came back very fast, and 2025 turned out to be a fantastic year. And why was that? That light blue line. Earnings never declined. Now, what we're likely to see, we talked about last week, was a redistribution to energy producers, but there is a very significant growth driver for earnings, and that's that AI boom. We showed it to you earlier, very rapid. Semiconductors expected to have a 66% increase in EPS. You might question years beyond, but it's very likely to have delivery this year. So it's important, though, that this energy shock cannot be a catalyst for a broader decline in other areas of the economy. That's why duration for the shock is particularly important. If this ends up following the path of futures, if the Straits of Hormuz are not open in the next 2 to 3 weeks, but the next 2 to 3 months, it's very likely that the US and world economy will be able to pull out of this to some extent. But the drop has not been as significant. We're not overestimating the impact like we did last year.
Great. So as we mentioned, if we go to the next slide, only twice since World War II have we seen a geopolitical shock associated with energy and the direction of the world economy, and we're not predicting, obviously, that is what the case is here. But whereas most of the energy price movements have been fleeting, the fact of the matter is that we're now studying the length of time of the impact. So for the moment, as Stephen has mentioned, I think we are looking at the curves and thinking the economy will be back on track, and we'll see what happens over the next 2 to 3 weeks. Next slide.
This just
So,
shows the sensitivity of various assets around the world. As the oil prices surged, non-US equities, which is still in the year to date, outperformed the US by about 4 percentage points, but they've lost a lot. This is a global shock. Last year, the tariffs were all on ourselves, but they were a very similar scope. But right now, you can see every asset price in the world. The announcements about the war extending for 2 to 3 weeks, the gold price has collapsed. The bond market is seeing losses. Energy is determining about 50% of all the movement in every global asset price. So all of this is going to stay very high in terms of correlation. It's a negative correlation to oil. But the whole point is that when the oil price moves in the opposite direction, you're going to see greater strength in assets like non-US equities.
and I think that is sort of the type of crisis activity that we've seen, right? Where the correlation is 1 to 1 and then it's -1 for a period of time, Stephen. But what's really been interesting as I look at all of the charts is that we've just seen a drastic movement just to get liquidity, right? To sell everything, right, in order to hold cash. And I think that's the reversal that is ahead of us to the extent that we actually have a normalization in the energy markets. So I think that is our last slide, if I'm not mistaken.
Well, there's one final
And I
one,
wanted to Oh, there is
and
one more?
just,
Okay, there you
just
go. That's
just
right. We always, yes, that's right.
I wanted to put this S&P chart on a log scale to try to give you the real dimensions right? So you can see, a percentage point is a percentage point rather than 100 points on the S&P. So what you can see here is that the types of things that we worry about for longer term asset allocation, for the reallocation of capital, is when the economy has been terribly misaligned. And you can see that in the late 1990s, where we had incredible excesses in investment spending. We could worry about that in IT in some places today. But what you can see is a market that was derailed over a couple of years before we started to get positive returns. 08, 09, a little bit more rapid in terms of getting to a decline, but the truth was it was still 2 years of large declines because we misaligned risk in the banking sector and the housing markets. You take a look at 2020, and again, we had the highest unemployment rate since the Great Depression for a month. Now, if only this could be over in a month, we would love that. But the reality is here, we did the payback for all of the inflationary impact in 2022. It still was not the same thing as misaligning an economy with true underlying booms that lead to busts. We'll worry about that with regards to things like how rapid we're increasing spending on AI infrastructure, those sorts of things. Right now, that's not the risk of the day. This energy shock will suppress the economy. It's going to worsen the balance between growth and inflation. But the reality is this is a conflict. This is a shipping problem in the Persian Gulf. And when that is resolved, we're going to see that the economy is able to realign in many respects. I guess our message is just to be a little bit careful that this drop last year, the 20% drop that we had, is an exaggeration that was very clear, created an incredible opportunity for a very sharp rebound. This time around, I think markets have been very proportional. They haven't exaggerated the downside. The truth is that this is a global shock. And right now, it's of unknown duration. David?
Thanks very much. We look forward to seeing you next week on The Point. In the meantime, we wish the astronauts on the Artemis II a safe journey to the moon and back. I just wanted to point out that the difference between what's going on now and the Apollo missions is that they're talking about the Artemis missions being ones where the men and women are going to stay on the moon. It's a mission to stay as opposed to visit. And I certainly hope that that mission is one that is successful and is in great contrast to the conflicts that we see on Earth at the moment. And we hope for the peaceful resolution of those and a peaceful journey for the astronauts. Thank you very much for joining us on the program, and we very much look forward to seeing you next week on The Point. And we hope that you'll read our bulletin this weekend, which is full of interesting facts on everything from oil to the moon. Thank you, Stephen.
Thank you.